Hi everyone, sorry about that. Now let's get going. As you can see, euro dollar has had a nice old recovery, again retouching that 130 level. We just had some very good data out from Germany, which is always good news for the Eurozone. You know, largely because it's the biggest economy. The ZEW survey, very, very important. One of the most important surveys, and that has done very, very well. So let's take a look at Eurodollar, and I want to show it to you. Someone just said no, Ara Fuller just said no voice. I think you might need to adjust your own screen, but I believe sound and vision are fine now. Okay, so this is the daily chart. So as you can see, very much within its kind of 3-month range. In fact, if anything, it's held nice support very nicely there around 128.80. So still kind of in the upper end of its range there. And if we just look at the weekly chart as well, yet again, it doesn't feel like we've kind of fallen off a cliff any as we, you know, if we think about where we started the year, we were ending it roughly similar. So let me just add in one of my studies, just go through one moment. Oh, sorry guys. Let me just add in a MACD. Actually, I'm going to add in an RSI. Hang on. I'm going to remove the MACD. Just bear with me one moment. Sorry, I forgot. I changed my charts yesterday, and I've been at a presentation this morning. So all back now anyway. So that's all looking good. But euro dollar, as you can see, you know, this is the weekly chart, as I said. Still looking fairly bullish. Let's go just drop back just to a smaller time frame. Obviously this 129.80 level adding quite a bit of resistance there, and then above that, of course, we're looking at kind of 130.05. That is the next major level. If we can get above there, then it really opens the way back to this high here, which is 131.40. But you know, we would say that, you know, certainly in the near to medium term, the fact that we now know our limits. So certainly in the very near term, we're range trading in euro dollar with 128.80 on the downside, which is this low here, which is that cluster of moving averages, as I mentioned to you just a moment ago on the daily chart. And then that 131.40 level is the high from October, which we then retested last week, and we haven't been able to get above there. So it's back to range trading conditions, and really the fact that we couldn't break above that 131.30, that 131.40 level, does suggest that we are consolidating for now. So we're trading within a range. Now, maybe the long-term trend is still quite bullish, but we are trading within a range. Now, I'd also say that obviously we've had this jump higher now. The RSI, I'd say within, as we approach that 130 level, from the direction of this RSI, that sharp move higher suggests that we could get into a bit of a sticky congestion zone there. So 130 will be very, very tough resistance. And really, for us to make another stab at that 131 level, we need to get over the first hurdle, which is, of course, 130. So that's the key thing to do first off. Now, taking a look at other markets, we have seen a bit of a calming in stock markets. European stock markets are higher. Even the Italian index, remember, that was down so much yesterday. In fact, the FTSE was down. The FTSE was down. You know, pretty much over 3% at one point yesterday, with some banks having to be suspended because they were so weak. So what we're seeing now is that, as I mentioned, that kind of consolidation period in stock markets. The other thing that's a big driver, and I'll show it to you now, just bear with me, is Spanish and Italian bond yields, obviously for obvious reasons. And we've actually seen Spanish bond yields. So obviously a lot is made of them. Hopefully you can see my Bloomberg chart now. But this is the Spanish 10-year bond yield. And the reason why I mention it is because there's a lot of correlation between credit risk and the performance of the euro. So it's an inverse correlation. So when credit risk is low, the euro tends to rally and vice versa. Hence why we've seen since July that fall off, and since July the euro's really recovered from that 126 low. So as you can see, yes, we saw a bit of a bounce higher yesterday, but it still remains at quite a low level, especially compared to where we were above 7.5% in the middle of July. So that's all you know, fairly good news. Now, obviously, Europe is front and center at the moment, but we can't also forget the US. In the US, we've got the fiscal cliff, but more importantly, tonight we have the Federal Reserve. Let's just move this one, and I'll just go back here. When you talk about Federal Reserve, especially today, we're talking about the prospect. There's an expectation now that the Federal Reserve will boost QE3 by approximately another $40 billion per month. So that means that they'll be buying an extra $40 billion worth of treasuries per month. And the reason why they're doing that is because of the reason why they're doing that is so that their other stimulative policy, this Operation Twist, comes to an end at the end of this year. They don't want it to end, but they can't really carry on with Operation Twist. So what they need to do instead is boost treasury purchases. So that's what they're doing. When you talk about that, the key thing that you need when you talk about QE3, an extension or a change in Fed policy, you really should look at dollar yen. So let's do that right now. And the reason why is that dollar yen moves very closely with treasury yields, and I'm going to show you at that chart soon. As you can see here, this is dollar yen, very much kind of range bound. This is the hourly chart, still quite range bound, not really having a big move. Now that is what one would expect in this is what you would expect in dollar yen as we lead up to a bit of a policy change. So we haven't really seen too much one way or the other. Obviously, right now you could argue that it's kind of towards the upper end of its range. Again, the RSI is pointed high. We've had a nice jump higher. We broke, we seem to be well supported there above 82 now. To take a look at it just on a daily chart, still kind of sidelining, and we are concerned about dollar yen in the sense that the trouble is more QE should actually be dollar negative to an extent. Now, we've seen in the past that QE can can actually weigh on it can actually weigh on the dollar, but not necessarily keep it low. So usually you get that kind of pricing in of more QE beforehand, so you see the dollar weaken beforehand. We haven't really seen that. If anything, we flatlined, and that's because I think there's a bit of expectation in the market that, well, how much will they actually do? Will they do 40 billion extra today, or will they do 25? Well, if they do 25, that's probably going to be considered fairly or not as dovish as some expect, and that could cause the dollar to strengthen. So we may then maybe make an attempt at 83. Currently 82.50 is acting as quite a stiff resistance zone there. I think the immediate risk really is for an extension of the consolidation period that we're seeing, and then we have seen for the past week, whereby investors are just waiting one way or the other. The other is that there is very good resistance, as I mentioned, 83 or just below 83, 82, 85, and then you get to kind of your 83.30 levels ahead of 84. So there's quite a lot right now that is a lot of resistance on the way up. So I think that's going to limit dollar yen gains. And for us, we actually think that dollar yen the 84 may be the high in dollar yen. Now, I just want to show you a chart, because some people say, well, what are you talking about with treasury yields and dollar yen? What does this even mean? Why is dollar yen so impacted by policy changes? And I'll just show you some evidence of how that is the case. Just bear with me one moment. I'm just pulling it up on my chart. Now, it's been quite interesting, really. This is the dollar yen chart, is the yellow line on that chart, and then the orange line is the spread between US and JGB, so US and Japanese bond market. So as you can see, it moves very, very closely together all along here, where the interest rate spread is widening in the dollar's favour, the dollar yen is strengthening, and then when it's contracting or narrowing, then we see dollar yen sell off. However, there's a bit of a divergence here. Now, they are tending to move in the same direction, but we've seen a massive overshoot in dollar yen. So really, this outcome the outcome of the Fed meeting today could be very, very important for the outcome of dollar yen going forward, because if that causes the spread between US and Japanese bond yields to actually narrow, then we may see dollar yen get dragged lower as well. Now, I do remember that the Japanese authorities are also on a bit of they're also very, very dovish at the moment, expanding policy, etc., etc. So in that situation, what we could see is the bond yield actually kind of moves sideways, and that should probably protect dollar yen downside as well. So we expect consolidation, certainly because not only do we have the Fed potentially easing later this week, or sorry, tomorrow, but we also have a quite dovish Bank of Japan as well. So that's our justification for this kind of consolidation, sideways moving phase. The other thing I want to show you, now some people are quite shocked at that. Now we talked a lot about Spain. Those of you who read our research reports, etc., etc., will know that there's a risk that Spain will be embarking on or making an aid request next year. It could be, its financial position is fairly weak. It's got a record amount of debt to auction next year. What does that really mean with, how does that really translate in the markets? Well, interestingly enough, what we've actually seen is this is the spread between the IBEX and the S&P 500. So it's basically the IBEX index minus the S&P. So it shows how one is moving relative to the other. So as you can see, for the first half of this year, the S&P was absolutely was massively outperforming the IBEX. The IBEX was in real doldrums. However, then kind of mid-July, a bit like with the euro when Draghi said that they'd support the Eurozone no matter what, we saw this recovery. But since then, we've kind of been moving sideways, but it still remains quite elevated. So, this is just really a trade idea, and it's one that I've been thinking about, because obviously we're coming up to, that time of the year where you're thinking about trades for next year, and, the US has got its fiscal cliff issue. It has got more QE, but, the fiscal cliff could potentially threaten things quite a lot. So usually when people talk about QE, they think, oh, that's good news for stock markets. Well, maybe not in this situation, because what we do have is the fiscal cliff. And really, if the fiscal cliff hits, that could probably be seen very, very sharply in treasury yields, and then that could be seen in equity markets as well. So that could be the key there. So in that sense, we could see a bit of relative value come into the markets, whereby things like the IBEX that have been, underperformed so much and still aren't back to the levels they were at just back in kind of January last year, may actually outperform in the kind of short to medium term, as fiscal cliff situations really overtake Europe as the main concern as we lead into the end of the year. That certainly makes market terrain in the stock markets quite choppy. Now let's take just a closer look at that S&P 500. Quick look here. So as you can see, it's recovered, but its recovery really is being stalled, and we think that is going to be the case going forward, whereby the S&P really does get kind of hit quite hard, and there's a limit to upside until we get the certainty of this fiscal cliff coming out. Now, obviously, we've got this news about coming out about Italy and elections and Spanish bond issuance, etc., etc. But you know what, the market really does like to look at one thing at a time, and I think between now and the end of the year, we may see the fiscal cliff issue be a problem. So for us, we think probably the risks are a bit more to the downside as we move towards the end of the year for the S&P 500. And we may, again, very, very good support 1380. That's a 200-day moving average. If we get below there, that is a very, very bearish development for this cross. So do watch out for that. 1450, capping the upside. So we're still range bound into year end. And we've recovered a little bit, but we do think that, for as long as this fiscal cliff issue isn't resolved, then what we may see is the S&P sell off, especially around periods of strength. So when you get some up days, like we closed above our 50-day moving average and our 100-day moving average, we think that's probably a bit of a false break higher, and the closer we get to 1420 may attract a little bit of selling pressure. Now, the other thing I want to show you is Brent crude oil. Just bear with me one moment. I'm just going to show you the generic contract because that's what kind of everyone's looking at right now. And the key thing here is you can see managed to recover around about that 108 level. So it's holding very good support at 105. Now the concern today is that there's another standoff in the Middle East, so in Egypt. That doesn't necessarily affect oil production. Egypt isn't a massive oil producer, but it's just the risks of tension in the area and whether or not it can spread elsewhere. And that for us is going to keep Brent very, very protected. As we said, in maybe not last week's, but potentially the week before, we do see 105 as being a massive, massive support level for Brent crude oil right now, with 115 on the upside. They're the levels, that's the range that we're looking at right now. And we do think that if anything, if we see kind of a further escalation in, if we see a further escalation in tensions in Egypt, maybe spreading elsewhere, then that could be the biggest concern for the markets just generally. So do watch out for that. We are more bullish Brent than we are WTI, certainly into next year. The spread between the two currently stands at $25, and we think it will remain elevated and could potentially continue to grow, maybe back towards that 28 level. It's looking a bit stretched, so we would actually look to not buy Brent until maybe getting some weakness. If there was a break below kind of 105, we certainly think that there would be some buyers coming in. So that would come in at around about 105. We think there'd be a lot of buying interest. Okay, the other thing I want to show you is cable. Let me just get back to my chart, and then I'm going to look at gold, because gold, again, another ultimate QE3 trade. But let's just look at cable right now. There's been a lot of people talking about cable after that comment that we got, or comments from the Chancellor. Pretty dismal growth outlook for the UK. An extra year of fiscal consolidation. It's all pretty rough. As you can see here, cable is very much following the overall market, though. It's not moving on the back of domestic fundamentals at all. Now, let's just go to a very long-term chart. I'm going to go to the weekly chart on this. And as you can see, we are fairly close to, we're currently above 160. The high of kind of 2010 was 168 there or thereabouts. We've been up as high as kind of 163 earlier this year and backed away from it. But we've never really kind of crashed off. But that's possibly because we've never really recovered in cable from the financial crisis in 2008. We've kind of been trading sideways. And that's what makes me worry about 163. I do think that potentially it's going to be such a stiff resistance zone that as we get close to, if we get close to it, people are going to sell it. Now, I don't necessarily think we're going to fall off a cliff, but as a short-term trade idea, I think the closer we get to kind of 162.50, the more selling interest will come in, and we'd look for maybe a decline back towards 159, which is that 200-day moving average, or the red line on that chart. Now, right now, we are moving sideways, so we're not seeing trending markets in cable. And you can see that on the RSI here. We're moving sideways. That to us is one of the key things. The other thing that we certainly would look at as well is whether or not we can, with cable, is how the pound may react to a ratings downgrade at some point during Q1. And we tend to think that a ratings downgrade probably wouldn't have too much of an impact, but would have a short-term negative impact on the pound. So, where does that lead us? Well, it's not a short-term trade idea. It's much more of a long-term one, that if we get back towards kind of 162, maybe 162.50, that would be a very good selling area. It's not the trade of today. I would think it's quite difficult, really, to trade cable today unless you're a very, very short-term trader. What about euro sterling? That's been quite an interesting one. Euro sterling has been again moving following in kind of these footsteps, but after reaching that high around 180, 170, it's really come off. We do think 80 would be maybe picked up on by some buyers, so by some bargain hunters. and we do seem to be basing right now around 80.60. So we may make another attempt. Again, as I said, like, you know, between 80 and 80.50, that may be a bit of a resistance zone where people go back in and buy euro sterling. Basically, on the back of the fact that, you know, maybe cable strength might peter out the closer we get to 162.50 in cable, and so watch that. I wouldn't necessarily trade euro sterling on its own. You know, no market moves in isolation, and what you really do need to look at here is you know, what you do need to look at when you trade in euro sterling is look at what cable's doing, look at what euro dollar is doing, look at what the spreads are doing in Germany, you know, in Europe's periphery. All of that stuff is important. So I did promise you that I would show you gold as well, and I absolutely will. As you can see with gold, it's been moving higher. Now, as I call gold the ultimate QE3 to trade, because around about the time, the July-August time, when QE3 was touted as being a potential policy that the Fed would implement, we've seen gold jump, absolutely surge towards that 1800 level. Very, you know, nice sharp move higher. In that case, and we have, you know, and it's drifted lower really since then, since people have questioned whether or not QE3 is doing a good job, whether or not QE3 is enough. However, this cross is very sensitive. Downside is limited in gold, we think, because the Fed is doing QE. So that's a really important thing to note. I think the other thing to point out is that we found very, very good support in gold around about this 1680 level. But on a day like today, in the short term, gold is going to be moved about by what happens over the next 24 hours in the US. Now, I mentioned the Fed meeting. Basically concludes tomorrow. We get the decision on rates and policy and whether or not they're going to extend QE to make up for Operation Twist at 5:30 London time. Let me just double check those times, but I can give you a nice bit of a breakdown so that those of you who do trade on fundamental data know exactly what's going on. Just bear with me. Rate decision 5:30. No change expected in rates, but there may be an extension of QE. At 7 o'clock, the Fed will release their projections of the economy and the federal funds rate, so the economy of the interest rate, and whether or not they will maintain keeping rates low until kind of 2015. And then the big one at 7:15 p.m. tomorrow night, London time. That is 2:15 US time. We are going to see Bernanke, who will hold a press conference. He will talk directly to the market, so that's going to be an important one. So we would expect that if they do more QE and they do around about 40 billion, we could see a knee-jerk reaction in gold. But whether or not the long-term reaction is whether or not Bernanke remains, holds on to this dovish speech, holds on to the fact that maybe the employment rate isn't as good as it could be. And that could limit gains in gold to around about that 1750 level. But we see us into year end meandering between this basically being range bound with 1680, 1660, really protecting the downside and attracting a lot of interest. The other thing to note about gold is that we're coming into Indian wedding season. So as we see some weakness, the Indian wedding season has kind of lost its potency in the gold market for a couple of reasons. Number one, obviously, global economic slowdown. India has not been spared. India's growth has been affected as well, and that hits on gold demand. The second thing that I would point out would be also that gold, so it's not just demand, but it's also been the fact that gold's been very expensive, so it's been a victim of its own success. And instead, people are choosing to buy it below maybe $1,700. So do watch out for that. During Indian wedding season, we do tend to see the gold demand remain quite sustained, and that to generate some buying interest. So buying interest on the dips, we think, with gold. If we do see hear from a very dovish Bernanke today, then we may retest 1800 by year end. And again, we don't think we're going to get above there, but we think that the outlook for gold is fairly constructive within this range. So we don't see it breaking out one side or the other. And if we bounce down to 1680, then we think it will attract some buying interest. Okay, guys, that's about it from me, but I'm happy to take a couple of questions if you've got any. Please do, if you've got a question, write it in your chat box or in your Q&A box, and I'll try and get around to it. Well, if there's no questions, guys, I'm going to leave you. Now, this is going to be my last FX Street webinar. Not for good, no, just over the holiday season. And I will be back on, I'll be doing my next webinar on the Tuesday the 22nd of January next year. So that's the thing to watch. Now, I've just got one question here from Danji, saying still overall short on euro means that it will hold. Well, it's interesting because let's go back to that euro chart just really quickly. The market has scaled back on its short euro positions, even though you're right, it is overall it's short, but that does seem to be protecting the downside at the moment. As you can see, very, very clear range here. We know our upper limits, we know our lower limits. Until something fundamental changes, which may not be until next quarter, maybe it's an ECB cut, maybe it's a Spanish aid request, we think that right now dollar gains are actually capped. So that could protect the downside in euro dollar, and we're seeing that right now coming around about this cluster of daily SMAs or simple moving averages around about 128.80. So that's the key thing there. So, okay, guys, thank you so much for joining. There will not be any more of these Trading Tuesdays for the rest of the year. As I said, the next one is January 22nd, 2013. So have a fantastic Christmas break. And do please join us back in January for that to get back into it. But enjoy your Christmas break. Take a break from the markets if you can. It's always good to get a bit of perspective and then come back in fresh in the new year and see how it is going. Okay, everyone, thanks so much, and please do, again, as I said, have a good Christmas and join us next year. Okay, bye-bye.